Hi everyone and welcome to another special episode. This time we will talk about copper, what drives its market price, how is the market structure, and what instruments you can use to trade it. So tune in, it's going to be all about the red metal.
This show is brought to you by Swissquote.
Note that this video is for educational purposes only and it is not financial advice. So in an earlier episode, we talked about how crude oil trades on headlines and how periodic data could help you understand the global trends. In this episode, we will dive into copper, which unlike crude oil does not necessarily trade on headlines, or at least not in the same way. There are no emergency meetings between copper producers. There is not a copper version of OPEC that moves the market by their decisions. There are no production quotas and no sudden supply taps being turned on and off. Instead, copper moves with the slow grind of the global economy. It is a metal tied to investment decisions, infrastructure spending, and long-term planning. This is why the red metal is widely seen as a bellwether, a barometer for the global economy, not because it is symbolic, but because it is embedded everywhere. Construction, power grids, transport, electronics, and increasingly the energy transition and of course AI. As crude oil, copper behaves like a physical metal pulled from the ground and processed through long supply chains, but not only, it also behaves like a macro asset that responds instantly to growth expectations, to economic data, specifically the Chinese data, and shifts in global financial conditions and so. Therefore, understanding copper means understanding where the economic cycle is heading globally and sometimes where expectations may already be ahead of reality. Simply put, when confidence in growth rises globally, copper tends to follow, and when that confidence cracks, copper is usually one of the first assets to feel it. So strip it back, copper market comes down to a familiar equation: supply versus demand. The timing is key, obviously. Let's dive into these two dynamics, starting with supply. Copper supply is constrained by design. Production is concentrated in a small number of regions, with Chile and Peru at the core, followed by China, the DRC, and the United States. Output is determined years in advance by investment decisions made on the very different price assumptions, which makes the supply with little flexibility, much exposed to demand or cycles of boom and bust. Then once a mine is running, well, it keeps running and it runs until something breaks. Labor unrest, environmental constraints, water scarcity, and political risks, these are all matters that actually matter more than the price signal in the short term. As a result, copper supply is slow to react and quick to disappoint. On the demand side, demand tends to be cyclical and expectation driven. China sits at the center of copper universe. Surprise! Accounting for more than half of global copper consumption. Obviously, it's got big industries and huge factories, explain why the Chinese are more hungry for the red metal than the others. But it's not even today's demand that moves copper prices, it is also tomorrow's demand. So construction plans here, infrastructure budgets, and manufacturing orders actually shape these expectations long before they translate into physical flows and actual data. This is why copper often trades on economic data, especially Chinese data releases, rather than warehouse numbers, for example. And as per crude oil, if you want to explain the trend in copper prices, well, the Chinese economic data is definitely a place not to miss. But unlike oil, copper demand is closely linked to capital expenditure. When governments and companies invest, copper demand rises. Look how the AI boom pushed copper prices higher since a few years now. Data centers, servers, renewable energy projects, and electrical rail infrastructure, they all require massive amounts of copper for wiring, cooling systems, and power distribution. And each new project adds measurable physical demand for copper, and because supply is slow to respond, even relatively modest investment surges can ripple through the market, pushing prices higher. No wonder the massive hundreds of billion dollars worth of investment in AI infrastructure globally is keeping the copper bulls well motivated right now. But it's not always rosy, it never is. When projects, for example, are delayed or financing conditions tighten, demand fades, and this makes copper particularly sensitive to financial conditions, including interest rates and public and private spending plans. Here, higher interest rates, for example, raise the cost of funding large projects, weigh on construction activity, on manufacturing activity, and slow down the investment cycle, all of which would be negative for copper at the margin. Then, as it is the case for most commodities, the US dollar plays a role too. Copper is priced in US dollar terms, so a softer dollar makes copper cheaper for the non-US emerging market economies, for example, and increased demand, acting like a tailwind for the price. While on the other hand, a stronger US dollar tends to weigh on prices by tightening global financial conditions. But note that this relationship is secondary because strong global growth can easily overpower the US dollar strength, while weak growth can drag copper prices lower even when the US dollar softens. Now we talk about supply, we talk about demand, let's put them together. If you put them together, well, the mechanics are straightforward. When demand outpaces supply, inventories decline and prices rise. And when supply runs ahead of demand, stockpiles build and prices soften. But in reality, the copper market rarely waits for confirmation. Prices generally move on expectations, and that's often well before imbalances show up in official data. And that makes tracking copper a blend of macro monitoring and physical indicators, and not necessarily very easy. Quite challenging indeed. So you have to watch the Chinese PMI data, credit growth, and fixed asset investment very closely. On the physical side, inventories at the LME, Shanghai exchanges, or COMEX offer real-time insights into market tightness, and you have to look at all of these and understand where we are. Sharp draws, for example, in inventories tend to reinforce bullish narratives, while persistent bills can quickly undermine them, just like crude oil. Soft data is not good for copper prices. Strong data is obviously good for copper prices. AI, electric vehicles, all of these trends are also very much important. Now, looking at the market structure, copper futures can trade in backwardation when supply concerns dominate and inventories are scarce, allowing investors to earn positive raw yield. But copper also spends long periods in contango during softer growth phases, for example. And in those environments, rolling futures becomes a headwind, even if spot prices remain stable. So here, ignoring the curve can turn a correct macro view, for example, into a losing trade. So it's very important that you understand the market structure at the time T and where we are. Now, so far we talk about supply and demand, what data you can watch to track these dynamics, and the market structure. Now it's time to talk about how do you gain exposure to copper. Now, copper is traded across multiple exchanges around the world: London Metal Exchange, COMEX, Shanghai's Futures Exchange, and prices can actually diverge depending on local supply, demand, and trade policies. A clear example of that, for example, came during the latest US tariff war, pushing COMEX prices higher, even when prices in London and Shanghai, for example, remain more stable for copper. Traders were suddenly forced to navigate not just global fundamentals, but also local bottlenecks created by these trade policies, which is obviously a vivid reminder that trade disputes can move prices sharply, even in a globally integrated market, and you can see price differences everywhere. But if you put that aside, coming back to trading in normal times, copper futures trade in different exchanges globally, and direct futures offer liquidity and leverage to investors, but they also come with volatility, roll costs, and margin requirements. So if you don't want to deal with the latter, copper exposed equity, so mining stocks, could provide a different angle to you. These mining companies also offer operational leverage to rising prices, which means that their share prices tend to rise faster than the underlying products, which is obviously a great thing. But because nothing comes free, these companies are also exposed to several political risks, geopolitical risks, and execution risks as well. So the best way to tame these risks, which we call individual risks because they concern one or two companies at a time, is buying mining or metals ETFs, so a portfolio of these mining stocks. And you can go a step further and opt for a portfolio of industrial metals, for example, to further reduce the risk related to just one metal. So voila, to summarize it all, copper is not a story about sudden shocks like it is the case for crude oil. It is rather a story about growth cycles, investor confidence, and constraints. Prices reflect not just where the economy is, but where investors believe it is going. So the challenge here is not reacting to every data point, but see the big picture and recognizing what expectations have moved too far, for example, in either direction to take action. That is where the real opportunities in copper tend to emerge. So I'll let you go ahead and discover, but this is all for this focus on copper. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this educative episode on copper has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again soon, and until then, goodbye.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.